Hello crypto cats, my name is Tom, I'm the crypto investor, and today I want to talk a bit about what is causing this drop and what we can expect really. So, for those who aren't aware, I do have a finance background. I worked as a financial advisor for over 10 years, so I've got a bit of a handle on the TradFi, traditional finance world. And what we're seeing right now is, of course, high inflation in the last few months, and so the Federal Reserve have to do something about high inflation. You've got two options really that they have in their armory to curtail that inflation. One is that they can slow down their bond buyback system. Bond buyback really is just how many tens of billions of dollars each month they are pumping into the system. And I'll show you that quickly on a chart. So this is money supply. This is the amount, it's basically how much money they're putting into the system. We obviously, I'm sure all of you who've been paying attention have seen that since 2020, they went mad. And 47%, 45% of all the US dollars in history were printed since the start of the COVID crisis. So we had that crazy jump up. And what they're saying is that, all right, maybe we've got a little bit ahead of ourselves. Maybe inflation is becoming problematic after that 6.8% reading. We need to slow that rate down. So they're going from 120 billion per month. I think they're gonna drop that down to what it may be 30 billion, 40 billion. And we're finding that out today and tomorrow. So the market is scared. The market hates uncertainty. Once we get that number, then probably a lot of money comes back in off the sidelines. But if they slam the brakes on and say we're not doing any more bond buybacks and we're raising interest rates tomorrow, then obviously the market drops a bollock. But so basically that's what's happening right now. And why this matters is because if you raise interest rates and you slow the bond buyback, we can take the stock market. Let's just put this back into a bar. Wrong bars, candles. Let's take the S&P. In fact, I've just deleted the S&P. Let's stick with the Nasdaq, and we can divide that by the money supply. So we can divide that by the money supply. And you can see that we get, quite a flatter trajectory. And if I do this actually with the Dow Jones, which is more value companies, like older incumbent companies within the US, then you get a much flatter. There you go. It shows the stock market actually isn't as high as it was back in February 2020 when you account for that 45% of all the dollars in history being printed. It's probably a much better illustration for you. So that's one thing. Money supply obviously artificially inflates growth. So you could do the same with Bitcoin. We could basically say that the growth in Bitcoin is actually 45% less if we account for all that money that's been printed. Now the other thing, of course, is to account for these interest rates. And when you raise interest rates, what you do is you make it a bit more appealing to keep some of the portfolio, so this is the big hedge funds, to keep some of their portfolio in cash because they can get a small yield on it, like 1 or 2% or so. And so they are less likely to allocate that money into companies that have future earnings, which are growth stocks, which are more speculative, which are somewhere you can park your cash based on it making revenue in 10 years from now. So that's typically what happens. So when interest rates go up, the money starts to focus fixed interest, bonds, and value companies, companies that are making money today. Your Procter & Gamble's and your McDonald's and Coca-Cola's and Nike, or whatever it may be. So why is this relevant to crypto, and why am I even talking about it with you? Well, the reason it's relevant is because you could look at crypto as the ultimate kind of growth stock. You could look at Ethereum as a really speculative growth stock. Ethereum's in the business of selling block space, and they're selling block space to companies that want to be making NFTs in the future, or companies that, or DeFi protocols, whatever it may be. It's still a very speculative. We know it's the future. We just don't know how long it is until we have that mainstream adoption. But we know it's coming. But we could be waiting another 10 years until it's widely out there. And so it's a growth stock. You can really classify it as a speculative growth asset. So that is why the market is selling off on this, because interest rates mean that the Fed is changing the system, they're lowering the bond buyback, they're increasing interest rates, And today and tomorrow we find out how much buy. And so the market just needs to wait until they get that answer, and then they can assess and carry on. The market has already priced in the Fed dropping the bond buyback, I believe, by 2/3, and they've already priced in 3 interest rate rises throughout 2022. If they indicate that it's going to be more stronger than that, then the market's going to sell off. So we'll see the Nasdaq sell off, and we'll see Bitcoin and the cryptocurrencies sell off further. So that's why basically the big smart money is waiting on the sidelines. And you can't underestimate how much of the market, it doesn't take, it only needs to be 5 or 10% of the total holdings to be held by hedge funds and venture capitalist firms who trade this for it to have big impacts on the market. If you look at Ethereum, we know that 70% of Ethereum is locked in staking and DeFi contracts and on exchanges. And so, what's liquid, you don't need much of a movement to really move the market. So someone like Three Arrows Capital may have reversed their $400 million Ethereum position yesterday on the back of this. You just don't know. Anyway, looking at Bitcoin specifically, because we still know that Bitcoin represents 42% of the total market. In fact, I'm going to look at it on this chart. What I've done here, so it's obviously very important. What I've done here is I've taken a clone of the market from when we had that big crash in May. We came back down here. And I've taken that clone and I've overlaid it to this. I mean, we could put it here, put it here. It's not an exact science, but it's just to give you an idea and hopefully give you some reassurance that this doesn't mean that the market is crashing and we're going back down to 20,000 or so. The genie is out the bottle. In 2017, we didn't know if this was going to be something that was globally adopted. We now know it's going to be globally adopted. We have a different rhetoric coming out of Congress. Everyone recognizes that this technology is useful and will play a part in the future. We didn't have that in 2017. We didn't have institutional adoption. We didn't have institutions holding it on their balance sheets. We didn't have hedge funds and VC firms buying it. We didn't have tens of billions of dollars every month being invested into new crypto projects by hedge funds and VC firms. This is different to 2017. It's less speculative. Anyway, so we take that clone, and you can see that if this is not an exact science at all, but if something like this did play out, maybe we get a fake out or something like this where it looks like we've lost our major important trend line, which has been holding for the last long time. A major trend line that's been holding for the last year and a half. And so everyone goes to cash then and gets terrified. And of course, that's the max pain point where the market likes to trick people and then come back up. So maybe we get something like this over Christmas or so. And if this played out, this would take us exactly to the end of January, and then we'd get a recovery, a retest, and a resumption up. Obviously this is a clone. That's exactly what played out here. So that's just one scenario. Not saying it's going to happen. What could easily happen is that, let's take this off, is that tomorrow, or tonight and tomorrow, the Fed indicate that they're not so happy to, that they're not going to raise interest rates for another until 2023 because they feel the economy is still too fragile and it needs more nurturing, and that they're happy to take that risk for inflation. And Bitcoin would probably bounce 15-20% on the news, and that would probably initiate another move up. So there's lots of uncertainty, lots of unknowns, but in general, this is a market that's going up and to the right. You just have to be patient. You shouldn't be messing around with leverage unless you really know what you're doing. Enjoy your Christmas. Come back to this in 4, 5, 6 weeks and check your portfolio there. But for me, the easiest way to look at this is long-term investing, like macro investments. We know that they're going to continue the bond buyback, maybe at a lower rate, but they're going to continue it. And so the dollar will continue to devalue, as it has done for the last 100 years. There will always be a demand for safe haven assets and deflationary assets, and assets that are going to make technology more efficient. The blockchain is just an efficiency system. And efficiency, if you only have to look at the Nasdaq. I think I've got a quite nice graph here. You look at the Nasdaq versus the S&P 500, and you can see how much the Nasdaq has outperformed it, because software is efficient. It's automation, and software will eat the world, and so will go the way with blockchain. So, we are right, and it's a long-term game. Don't get too caught up in the day-to-day. It's probably very likely that we see something like this and a long extended bottom, and we do something like this. It's just how it is. The cycles within cycles. So hopefully that's in some way reassuring. I'm not a soothsayer. I haven't got a crystal ball. I'm just a guy on the internet. Please do your own research, but this is just how I see things. I hope you found it useful. Please hit the like button if you did get any value from this, and comment and subscribe and all the good stuff. And I will speak to you soon. All the best.